So tonight I want to talk about if you had a full-time job, and most of us do, right? We have a full-time job and we have obligations doing the regular market session. Right? Maybe we can trade like Dr. Meadows does during his full-time gig. He can still trade in between seeing patients and so forth. You might be able to trade in between whatever you're doing. But if you cannot, and you can only trade at night, it does not mean you can't be successful and at least be able to supplement your income over time in a substantial way.
Please subscribe to our channel. Make that cash a blaze! Have fun trading and manage your risk.
And what I suggest people do, especially people who are super new or wanting to make things as simple as possible so that it's not a lot of buttons and switches and things they have to do for them to be able to make a consistent income. And that's simplify things to the point where you're just trading the S&P 500, and that's the ES at night. So you need options on futures capabilities, right? Approval. You need options on futures approval, and you can get that from your broker. And if your broker doesn't give it to you, then you should go to a broker that will, something like TastyTrade. So you can have not only options on stock, but options on futures. So if you needed to only trade at night, then you can. So tonight's premise is that that is the best option for you, is that you need to trade at night. So what I suggest, and I just say that let's say you had $10,000. I like to use the $10,000 number. You might have less, you might have more, but using the $10,000 number, you can easily understand what you need to get percentage wise. This might not be a great absolute dollar amount for you, but we want to think of things by percentages, because someone can say that they made $2,000 a day, but if their account is significantly large, then that can be an insignificant percentage, right? And you can say, I have $10,000 and I did, 2%, or I averaged 5% a month. The person with $1 million might have made more absolute money than you, but their performance percentage wise could be significantly less, right? So if you were able to, um, do your process in a linear way, so the more money you have, then the more the absolute dollar amount you should be able to make. And that's true in a lot of aspects into up to a certain level. But most retail investors don't have to worry about that certain level, performance wise, and because it's millions of dollars. So, but let's say you have 10K and you want to make 2% of that 10K consistently. Well, that's going to equal $200 a month. And if you wanted to make 5% consistently, then that would equal $500 a month. So when you're doing this, you want to do this not using the 10K, but only using 40% of your account. That's what we teach at the Dorian Way. 40% of your account to initiate trades. So that would be you're only using 4K to try to make 2 to 5% consistently per month. So how can you do that, and do that with the most risk averse way possible with the super high probability of winning? I think you need to break it down and do something like one trade a week, right? We're gonna kind of like 5 steps, right? You're gonna do the first step is you'll do one trade a week. Keep yourself engaged. Keep yourself engaged, keep yourself following the markets. You don't have to trade every day, but you want to put on some new trade every week until you hit your threshold. Your threshold doesn't have to be 40%, but that's what you want the max to be. Your threshold could be 30% when you're really afraid that things are making you nervous in the market. You can change that to 25% of your account, right? Because the smaller the better when you are nervous, when you're feeling like it's some danger out there. You can just step back, because there's always going to be opportunities to make money in the market. It's never going to be a time that you can't find something to make money on. You've missed the dot-com bubble because you were a baby or whatever the case. We weren't even born yet. You missed the dot-com bubble. Well, we've had several other bubbles since then. And we're going to have a lot more bubbles in the future, because that's just the way our markets are, and they've always been that way. It's the boom and bust type of cycles. And this AI situation is going to be potentially the next bubble. I don't know, right? It's early stages at this point, but NVIDIA is definitely benefiting from it. And maybe with this kind of metaverse type of stuff, maybe Meta, or formerly known as Facebook, maybe they're going to benefit from that, right? That was a craze and a hype there for a second. It's less talk about that right now and more talk about AI. But we'll see what happens in the days to come, in the months and years to come, what really is a bubble. But coming back to this, you want to be vigilant and not use more than 40% of your account. So the first step is that you're going to look to put on a trade that you can put on a trade weekly. So your first trade could be something that is, let's say, 7 days out, 14 days out, or it can be what we call our bread and butter time frame, 30 to 60 days. And when you're laddering stuff, it doesn't necessarily have to be 30 to 60 days. You can do something that's 200 days away. Similar to what we have in this account, as you guys can see, we have a 6 day, we have a 16 day, we have a 21 day. This is all in the ES. Excuse me, I hit the wrong thing there, but let's go down here and look at it a little bit more. We have a 30 day, a 33 day, a 35, a 37, a 99, and then we also have something that is a lot further than that. We have the 160. So that's all different positions in the ES that is expiring at different times that have different risk levels. Okay? We receive different premium, all of that. So if you were going to start and you had that $10,000, and let's say your first trade, you were going to do something just to keep you engaged immediately, you were going to do something that was 7 days out. So we have, in this example, we have four different type of trades on, and I'm gonna give you guys a visual of this so that we can all understand what I'm talking about with this type of bread and butter laddering type of strategy that you can use with the full-time job to be able to consistently make money trading only at night, because your full-time job requires too much of your attention during the day, so you can't really focus on your positions very much, besides maybe looking at your phone from time to time just to see what the market is doing. And I encourage you to be able to do that, right? You want to get up, you want to have your hand on the pulse of the market, and you'll get that just by watching it from time to time on a consistent basis. Okay. All right. So if we clear this and we go over here and let's just do some white space, right? So the first trade that we had, it was going to be 7 days to expiration, DTE. Okay. And we were collecting $75. Okay. We're going to do this type of trade on a weekly basis. That's our short-term engagement trade. And as I say, that's going to require $1,000 to do the trade each week. Okay. And buying power, that's BP. Okay. And then the second trade that we did was 40 days to expiration. And I'm just going to put these lines as DT up there. And then as I say, we collected $100. Okay? And the buying power that we used on this one was $300. Okay? And then we went out and we did a 51 days to expiration. And in this one, we collected $60 because we just did a call spread. Okay? And the buying power that was required for this was, let's say, $500. Okay? I'm writing that poorly, but you guys get it. All right. And then the last one we did, we went out to 112 days. It's just examples, you guys. This is a real life example that you can do, but this is this example. You might not want to do 112 days, or you might be okay with going out further than that. And let's just say we did more contracts here. So we got $500, and the buying part is required for 112 days for this for 5 contracts was $1,000 in the account we're looking at. Right? So if we break this down, we have 7 days plus 40 days plus 51 plus 112 days, and we divide it by 4 so we can get an average of our expiration period. So our average expiration period in this example is 52 days. Okay? 52 DTE. What we're collecting here is $75, $100, $60, and $500. Okay? We're collecting $735, and we are using, in this example, we're using 1,000 plus 300 plus 500 plus 1,000. We're using $2,800 in buying power. We say we can use as much as 4,000. Right? So this is an example if you didn't put on anything else and you just took profits on these type of trades. Okay? You just took profits on these type of trades, and let's say one of the things you want to know how to do when you're doing these is when you take profits. You want to know how to take profits and when you take those profits. So you're going to take profits at 50 to 75%. When I'm trading the ES and when volatility is outside of the risk zone that we call, that's below below 13 and above 21, I'm going to be taking profits around 50%, 50, 60%. When it's in between those numbers, it's at a historical average, let's say 15 to 17, I'm going to be taking profits on this S&P 500 at 75% or very close to that, because that's what I want to get on these stock indexes. So if you did this, right, and let's say you took the profits at 735 and you had 75% of that, well, that's going to be $551. Well, in this example, you would have made 5%, 5.5% on your capital, and you've put on no other trades. But we know, because you're doing a laddering process, that these trades you're going to be putting on a trade weekly for the 7-day trade we talked about. This is going to be coming off and putting back on often. This is going to be coming off and putting back on often. And then obviously the 112 is going to be coming off and putting back on. If you use this amount of capital, and let's say you're going to have on 4 trades consistently, you're doing 1 trade a week. Well, you're going to constantly taking stuff off and putting on, and then you're going to have some stuff that go wrong, right? Stuff that doesn't go as planned, or you're going to need to know how to adjust. And eventually you're going to need to know how to adjust. Yes, you can take this off at 3 times or 4 times the original credit you received. So what I mean by that is that, let's just say that you received $100 when you did the trade, right? 3 times 100 is 300, 4 times 100 is 400. You get out at that point if the trade is trading for that, right? If you sold it for 100 and it's now trading for 300 or 400, you can say uncle from that. But I think if you learn how to adjust these bread and butter type of ladder strategies, you're going to benefit more over time, because you can do if you did an iron condor and the market starts to go up a lot, or your put side is going to be very, very small delta, you can move that up, collect more. The more you collect, the less max risk you can have, the better probabilities you can have of potentially winning by how much you are collecting. Okay? So, and then you can always do what we call rollaways of the tested side. You can do stuff that's roll out to be able to allow duration to help you be able to win when things are going against you. Okay? But that's why we say you want to be an expert at lesson 7 in the Dorian Way school. But until you're that way, you want to understand 3 to 4 times your max loss.